All right, so we finished the holiday week here, this 3.5 day week, with a little bit of expected sideways action today. Not very much of a move. We did have some significant technical moves, technical indicator moves, especially on the small cap index. So I'm going to break down what those charts look like and what they mean, what kind of expectations we should have after what's been kind of a record month for the small cap index this November, especially one. The type of move that you would expect maybe in a month coming off of like a bear market low point. But we haven't come off a bear market low point. So very, very big move in small caps, big move all across the board in stocks. But we're going to break down what that means and what we can expect with the last day that we have left in November before we move on into a new month. And see if we might have pulled forward some gains from the end of the year into this one particular month. Today is Friday, November the 27th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. I mentioned this before early in the week, but if you check out up here at the top, you can see our Black Friday sale, this bar up here at the top of the screen. If you click that orange button and you use the coupon code for Black Friday, or Black Friday, one word with a capital B and a capital F, you just come down here to subscribe to the site. Use your coupon code right there where it says "Have a coupon." Just type in your code in the box that pops up there. For some reason, not coming up for me right now. It's refreshing the page for me for some reason. If you want to pay over 6 months, you can use PayPal. Just make sure you check that box right there and apply for their credit, that PayPal credit, and that will give you the ability to pay over the time. Otherwise, one thing I did want to mention, normally our monthly subscribers pay $99 a month, and then this is the things they get access to. All of our trading rooms, as well as our Market Outlook live videos and other things here that our free subscribers get. But our premium subscribers get all of that and this for if you use the Black Friday code, you get all of this for $66 a month on average. So kind of keep that in mind. That's a pretty significant deal. Our monthly subscribers aren't getting hardly any of this. All these premium resources and tools and class forums and Q&A sessions and charting scripts and all of these things, and you're getting it at only a third off of what the regular monthly subscriber gets for essentially the trading rooms and the Market Outlook live videos. So it's a significant deal. We only do it once a year, and it's this, and you have until midnight on Monday night through the 30th to be able to use that coupon code before it expires. All right, well, let's take a look at the S&P 500, see how we finish up the week on the market forecast. You can see we were the last couple of days, Wednesday and then today here, the half day, just floating towards the top of that long upper shadow that we got on November the 9th, the day that we got the dual news of Pennsylvania giving their electoral college votes to Biden, which clinched the vote for him, as well as, the Pfizer vaccine news all came out. And every Monday since, we've had new vaccine news has been positive. But you notice after the overbought cluster that we got on Tuesday, we are still flirting at that resistance level. The resistance being the top of that long upper shadow, which is so rare to get long upper shadows. But that's a good resistance. Break through that and we're going to feel really good about life. Hold that, and there's a pretty decent chance we can come down and retest that 30-day moving average again. So, but regardless, dark green shading and a green line all across the board here on the Dow, which also got a cluster here. Excuse me. The cluster, the NASDAQ is back to getting. We briefly had dark pink or light pink shading in the yellow line, but the NASDAQ is also floating up above this 78% Fibonacci retracement level. And then finally, the Russell 2000, which has been the big winner. Still kind of got that near-term divergence setup going on after the overbought cluster on the first near-term high. Now the divergent high point coming off of that, pretty significant too. I mean, that's an easy, very much higher high. Not even close to, not even like kind of higher high. That was a pretty significant higher high on a near-term level after a brief dip below the 50th percentile, and then of course the easier lower highs here. Even though we did dip below 50, it's usually divergences are better if you don't. And you did get back above 80 on the second high, which again, divergences are better if they don't. But regardless, that's something to keep an eye on to see if that is what gets us down to retesting the 30-day moving average as far as up above it that we are. If we take a look here at how far above the 30-day moving average we are right now, here we go. You'll see that we're about 8% above, and that's flirting with similar levels. We were close to 10% above it over here earlier this week on Tuesday when we got the overbought cluster on the S&P. We were about 9.5%. So that kind of gives you an idea of how high we are. It kind of puts us up there with that June peak. As you can see, it puts us up there with this peak here in late April, when we were first coming off of the lows. So pretty significant move off that 30-day moving average that we've seen before, right? And we've seen before when we've had this kind of outperformance in the small cap index. Of course, the S&P is kind of the main one we watch. Let's take a look at the weekly chart for the market forecast, and again, that kind of really stands out too, how far above the 30-week moving average we are. So if I were to do the same indicator here, keep it on the same level. So we'll do just current price there to the 30-week moving average. Again, you can see the significance here. We are in the 92nd, almost 93rd percentile. We are about almost 10% above it. Very similar to early 2018. Very similar to earlier in that early September high point that we hit. And again, that over here, we're about 9.5% now. That's about where we got in May 2013 before we had this period of volatility with multiple retests coming off of a cluster. We are not getting a cluster this week or last week. We came pretty close a couple weeks ago. Again, that kind of doji pattern that we ended up with that Pfizer news. Then we didn't follow up with it anywhere, and we're still kind of flirting with that high point. We'll see how that ends up playing out. The Russell 2000, however, when you look at it on a weekly chart, its weekly market forecast, you can see we are 18.5% above its 30-week moving average, coming off of an overbought cluster as itself. Just barely turning bullish though, like we just barely started with dark green shading and a green line. You tend to get some overbought clusters early, and that kind of solidifies a new trend. You can obviously see the new all-time higher highs, but that just kind of shows you just how far up above. Like again, we're talking like 2009 levels. Here, 2010, we got close to 20%. We are 13. We're at 18.5%. Over here, we are. This is the highest. We're at the 100th percentile. So that means that this is the highest close above the 30-week moving average that we've had in the last 20 years, including coming off of some significant bear market lows that also had clusters, right? So, that just shows how big this move has been. And just kind of gives us an idea. We've talked about, or some people have talked about, this is the best November that small caps have ever had. And we'll see if that is able to carry through into what is traditionally a strong December for the small cap index and for growth stocks. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked the video today and that you want us to do another video again on Monday. It's a quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch them. But if you do like our videos and you want to let us know, you can do it with one click right now while you're watching. It's a great way for us to see kind of what you're thinking, and it helps us out because the more engagements these videos have, the more our followers and subscribers to our channel will see them, because these platforms will promote our content to them. Also, while you're down there, comment. What did you get out of our videos today? I'd love to see what stood out to you, what questions or comments do you have. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Remember, like as I mentioned earlier, we had the Black Friday sale going on. Check that out. You can also follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. Hi, if you're watching us on our blog here, our video here embedded in our blog, check out some of these other things on the right, including some of these premium resources. I know a lot of you, we've had a lot of new subscribers this week taking advantage of our Black Friday, and we have some of these premium resources you can see popping up over here on the right, how you can be able to get started with those. You can see them all posted here as well in the menu. Also, while you're over here, check out our Market Outlook live videos. Both our premium and our monthly plus subscribers get access to those. That's where I go back and I look at all these old trades we've been talking about in every Market Outlook video that I do. Because we stay in them until we get out of them. And so we look at them every time I do these videos. We take a look at all of them. So that's unique, because you don't get that on a lot of other like TV shows or other platforms. They'll tell you a trade, but then they won't look at it again or talk about how to manage the trade going forward. And so that's a big deal to us. So we do that in those videos there. I get asked about that all the time, so that's why we put that together for you. Also, while you're here, come down and click on this heart. It opens up a new window. Hit that like button right there. Click on this thumbs up. Also opens up a new tab for you. Hit that thumbs up icon as well too. The more you do that, like I said before, the more people will see our content. There's a lot more than 134 people in this group that follow this page, and that's all that saw this. And so the more likes it has, the more people will see it. Same thing with Twitter. It benefits you because these platforms will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look at this other weekly chart of Hakinyashi candles. And you can see how high the PPO still is, very, very high there. But you can also see too, we did get a slightly higher high, we did get a slightly higher close. So not as not as bad as it could have been. But again, we see how the candles are getting smaller. It's very typical for bullish moves, is for these candles to get smaller. And so we will have a pretty decent, we're going to end up here at about 35.67 maybe-ish next week, the open. We're already trading at 36.38 at the high there of the week. So it's going to be a pretty decent body to start off. And it's obviously going to be a higher body, a higher close. And we'll see how we finish up the week, of course, and as to where the close will actually end up being. But that's a pretty decent candle. You can see the Dow's pretty decent size. The NASDAQ, unfortunately, still hasn't really broken out yet, and that's its problem. The Russell, on the other hand, has. And to get such strong Hakinyashi candles on a, again, we saw this before here in August. We saw it over here even in June. These are some strong Hakinyashi candles that typically you get your biggest bullish candles at the beginning of a move. When you get strong bearish candles, and you follow up with strong bullish candles. To get really strong bullish candles when we haven't been bearish, again, it's got a little bit of some blow-off toppiness to it on the Russell. So we've got to keep an eye on that, especially with, again, how high that PPO is. You go back, 20 years, and it's pretty darn relatively high. We're almost 10% there on the weekly between the 50 and the 200-day moving averages. And just to kind of show you, I showed you before how high it was off the 30-week. That's about a roughly 150-day. But let me show you here how high we are off of the 200 days, so the 40-week exponential moving average here. We are 20% above that. Again, the highest we've been in 20 years. It's a very, very high level. 20% is a big number. It is a really, really big number. In fact, if I were to go as far back as we can here, it only goes back to 97 on this particular index. That's 91st percentile. Over here we were what's that, 16% there and then over here we were at 25% above, and that was in the early 2000s when things kind of really hit. So, again, we're kind of like flirting with like, 90. And now, granted, the PPO was much bigger there than it is now, but that kind of shows you too how big this move has been to get that far above the 200-day moving average, whereas the 50 hasn't been able to. That was a little bit more. It took a little bit longer to get to that point in 99, 2000. Not so long this go around. So, again, some little blow off toppiness, so to speak. You take a look at the 3 green arrows. We obviously have 3 green arrows again. That momentum is not very strong, though. In fact, when you look at the MACD, it's got some divergent, high point setups here on both the stochastics and the MACD. And if you take a look at some of these other oscillators, you can see a little bit of some divergent toppiness here as well. Then we look at the DMI, and we're looking for that ADX to really get going. And that's, again, it's been stuck below 20 pretty much this whole time because we haven't broken through that November 9th high. So if that negative index can break through, great. But otherwise, again, some divergent highs showing up there on the positive directional index. You can see the positive for the Russell has gotten all the way above 40, which again we saw in June, and that tends to be pretty overbought. In fact, the ADX is actually a lot higher now than it was back when we had that. So again, it's about as strong of a bullish directional move as we've seen in the small cap index. The S&P is trying to get going, but the Russell 2000 is on a very, very strong trend and very high up above that blue line. Again, the blue line is the midpoint of the 26-day range. It's kind of hard for it to extend too far away without kind of going sideways or down. You can see a couple instances there, sideways or down, when we're this far extended away from the 26-day midpoint of the 26-day range, which is again that blue line there. Finally, we'll take a look at the intraday chart, and you can see we got about as close as you could get today without getting a new high tag. In fact, it looks like the highest we got up to right there, 364.18. 364.38 is the high tag. So, we are that close to getting a new high tag over here on the right. And we did fill in today's gap. We did not fill in Tuesday's gap yet, and that's very much considered a common gap, in my opinion. We are above the point of control for the 4 weeks. If we were to fill that in, that might be all we do, considering that support. But if we don't hold that support, then we're going to really start. There's nothing. There's no volume. We've been so sideways for so long. In fact, now, if you take a look at the Arun indicator after today's move, which, remember, the Arun indicator kind of shows us visually where these high and low tags are. All right, because the low tag's not going to be over here for a long time, but the high tag, when the low tag's over here on the left, usually the high tag's way over here, which, almost was the case, but hasn't been, which again shows how sideways we are. So the Arun tag visualizes that, or Arun indicator, and they're now almost both below 30. So usually this leads to a breakout move. As of right now, we'd have to anticipate a breakout to the upside, but until we do, we expect resistance to hold at the top of that candle until it doesn't. So we'll kind of keep our eyes on that. Volatility fell to its lowest level. You can see it dropped all the way down to the 85th percentile, even though still we are above the 20 mark. We talked about this in our class on Wednesday, that we've been pretty. The volatility has been holding up for a long time. Even over here when we got really bullish on volatility, it still stayed 20. It's very rare for us to get that bullish in this bullish zone, but not drop below 20 here. Because when you drop below 20 now, the market's like, okay, we're feeling pretty good about life. But you stay above 20, the market still got concerns. And you can understand that in August because we had the election coming up. It was really kicking into gear. Now, with the election and vaccines, it shouldn't be above 20 still. So what does the market still have concerns about, if we're getting all this positive news? In my opinion, it's the short-term choppiness, or short-term toppiness, excuse me, of the market. Now, I've shown you this chart before, and this is how many stocks are above in the S&P above the 200-day moving average. We're still at 89%. That's the highest figure that we've seen since we're in QE3. The difference between now and then, though, was the 200-day moving average of this index wasn't as low as we are right now. In fact, during the credit downgrade, the 200-day moving average of this index never got as low as it has right now where we're at. So that's a really wide gap between 89 and 50. It's like a rubber band that's really stretched. It doesn't mean that we can't be there, but usually this line, if there's such a wide gap there, it's easy for it to come down to it. Very return to the mean type of a situation. Doesn't mean it has to fall all the way down to zero. In fact, very likely won't again. But can it come back down below 60, 65? Definitely. And still bring that line up because of how high it's been. So that's kind of why I think the market still got that VIX up high, because it's waiting for that type of move before it can really break 20 and maintain a new multi-month trend going on. The last thing we'll take a look at, obviously the volume today was very light, and the trading range was very small because only half day. You can see 1.6 in the volume. Look how light that was, and it was that way on Wednesday, and we had a very small range there too. So to kind of give you an idea of what those averages are, they're coming down to some relatively low levels too already, without, again, the VIX breaking down. Now we haven't broke the 1% level either, so that's breaking 1% on the ATR means very small moves, very slow grinds, and we'll start getting some really small moves here. So the historical volatility has come back down, but the VIX is still kind of above, and it's okay. We can maintain some good moves, but again, for the implied volatility to stay above 20 here, that's what this line is. And for the implied volatility to be above 20, and for the historical volatility to drop back down, eventually that leads to this kind of pop here, because remember, implied gives you the expectations going forward. So when the historical stays up, when implied stays up, historical usually will stay up or pop up. So just kind of we'll keep a close eye on that going into December, whether or not we can finally entrench ourselves in this trend, or if there's a reason why the options market at least, still has volatility as high as it is. So really quickly to summarize this technical outlook, we've got a bullish trend, we've got the beginnings of a bullish trend at least, but very, very frothy indicators, which has been great for our long-term portfolio. In our class, our long-term portfolio has been positioned very well for this type of move. We've anticipated it. It's been playing out over the last few months. It's been doing very, very well. So from a long-term perspective, great. This is good. But from a short-term perspective, it makes it difficult to really load up on the bullish directional short-term trades, active trades, because of the frothiness, which is why the VIX is still up. So I'm still leaning from an active standpoint to maintaining some neutrality and maintaining some negative deltas just in case of this type of pullback, while kind of putting in some safer, lower bullish delta trades inside of those negative deltas to kind of stay neutral, right? Stay neutral until we get, in my opinion, the type of move that as I said before, the options market anticipates that we will get, which is why the VIX is still where it's at on an absolute basis, up above 20. So that's kind of how I'm leaning, while still maintaining, the long-term positioning that, despite any volatility we may or may not get in the next month or two or next few weeks, from a long-term perspective, I'm still about as bullish as you could possibly be and have been for a while. So don't get too confused when you hear me talking about frothiness and short-term technicals. Don't get that confused with what my long-term position has always been. And market scholars know very well, why I am that way. But my long-term position is still very strongly bullish going forward, and we're positioned like I said, in our portfolio management class, our long-term class, our portfolios are positioned very well for that. But from an active trading standpoint, which is a lot of what we do in these market outlook videos, boy, it's still, these indicators are looking pretty, especially on the small cap index, which has been leading us up here. And even, as you'll see here in a little bit, it might be running out of gas from that perspective. So that's kind of how I'm leaning. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section down below, especially if you disagree. What charts or indicators suggest to you either that you're a lot more bullish or a lot more bearish than I am? All right, now let's take a look here at how things have been performing here. And you can see over the last 3 weeks, it's been small cap world and we're all just living in it, right? That's been the last 3 months, excuse me, especially since that September 24th low point. This one right there, right? Since that point, it's been real estate and utilities led the charge initially, and of course, since then it's been industrials, financials, and materials leading us up. But you can see off of that low point, I mean, small cap index is up 28%, more than doubling the S&P 500. That's a really good annual return, much less just over a couple of months. You can see the safety trade very, very bearish, especially gold really dropping. Even with the dollar down, gold's really dropped too over the last couple of weeks, really since that vaccine news that's come out. In fact, if we were to take a look, as I've shown you before, coming off of after that day, so the day after that vaccine news, again, we're relatively flat. In the last couple of days, we made a run up on the S&P, but the small cap index is up 8% while the market's been flat, right? Well, because this is the high point of the 9th, right? For the S&P at least, it's the high point of the 9th. And you can see again a big push in the last couple of days for risk appetite. Really this week, since the beginning of the week, here to the 23rd, you can see that again 3.5 day week, but just this week alone, on the last couple of days, it's been a big push and a big drop in the safety trade. So when you look at like gold here, let's take a look here at gold really quickly. You can see, it's come down and it's flirted with that 200-day moving average. There hasn't been a whole lot of strength in the U.S. dollar either. If you can see, the Euro's actually kind of had a bullish week, so some weakness in the dollar, holding up above that 50-day. We still haven't had that test of the 200-day, and I think that's coming. I think that's coming there. And if the dollar were to rally, that would put some more pressure on gold, as it flirts with its 200-day moving average and potentially a falling PPO. I don't think gold will necessarily start to bear market trend lower, because again, it benefits from a weak dollar, and I think the dollar will be long-term weak. I just think the dollar will be more bullish in the short term, so that will put some pressure on gold here, probably flirting with that 78% retracement, maybe this 100% retracement level. You can see a big beneficiary this week too has been commodities, and crude oil specifically finally breaking above its 200-day moving average and getting really darn close to getting its own golden crossover here with this PPO crossing above zero. So it's been rare for especially all this year, because we rallied and we kind of been stalled, but finally a little bit of a breakout on commodity prices, on crude oil specifically. If you take a look at commodities as a basket here, that's a pretty significant move there. We had already closed above the 200-day moving average, but breakout move this week. Very, very strong move, and there's some potential here for for a move to go a little bit longer in commodities. If you take a look at the volume, you can see I've got the point of control, we're almost in the value area for the here, let's get rid of this probability of expiring cone. We're almost in the value area, and that's going to lift us up towards this 15.5 and we're breaking above the upper Bollinger Band on the weekly chart, mind you. So with a very, very low bandwidth, so we're looking at a breakout on commodities, which again follows suit with weakness in the dollar, and that's I fully expect weakness in the dollar here, even though the euro itself is kind of getting above its upper Bollinger Band. We'll see how that plays out with a falling bandwidth. It has not quite turned back up yet. All right, I did mention earlier, this is just this week, mind you. So this is coming off of last week. So energy gapped up about 3.25% on Monday. Eventually peaked to about midday Tuesday, right about the European close there. 12.5% gain for the week before pulling back down to only 8.5% for this 3.5 day week. Financials really kind of broke out too. You can see industrials, materials, and then since early Tuesday, everything has been kind of flat. But again, like I've shown you before, from that September 25th low, where initially it was utilities and real estate and financials that kind of led, it's been energy up 28%, financials 22%, industrials 18%, materials 16%, and then utilities and real estate lagged behind this week. And you can see all this discretionary and technology and communication services at best matching, if not lagging, the market during this time frame. And of course, our safety trade really lagging too. Staples and all the interest rate sensitive areas like kind of lagging behind here. But that just kind of shows again the strength of this market and where it's been. In fact, again, off of that 1030 low point, that's where the bulk of this move has really come from. 36% on energy off that 1030 low, 19, 17, 13. Big time moves with some big lagging moves in these big sectors that typically follow. So, I mean, those are 8%. It's not too shabby in a matter of, a month. But, and 10% for the S&P is not too shabby for a month, but not 36%. And that's our leader. And that's not your typical, like, sustainable leader, right? That's the smallest sector in the S&P 500. It's the smallest. Energy as a weighting in the S&P is the smallest it's ever been. So if the smallest sector in a market cap weighted index is your biggest winner by far, that's not your best. In fact, again, we saw this in June when they had these kind of moves, outsized moves. They corrected pretty hard. Not when the market itself necessarily turned bearish, just when the market exhaled, right? Just a little bit of an exhale. They corrected pretty hard during that exhale because they moved up so much during the inhale, right, during the impulse move. All right, so for our trade idea of the day, I wanted to take a look at a stock that's actually got earnings coming up here, and that is Lululemon. Lululemon has been kind of breaking out itself on this kind of, in fact, it almost got an overbought cluster, which is pretty significant at the beginning. It's one thing to get an overbought cluster when you've been bullish for a while. On the intermediate line, the green line, you can see it's been bullish for a while, and we kind of got one here at the beginning, which kind of solidified the bullish run, and we got one at the end, which kind of signified it's a little too long in the tooth. Well, here this would be one almost at the beginning, so pretty good bullishness there on Lulu. You can see that it's got 3 green arrows. Doesn't have a big jump in volume there. The 2-line versions of Lulu, you can see where the 8 and 17, everything is rising above rising moving averages. The RSI and the CCI look strong, above 60, well above 100, above close to the positive 200 there. The directional index is showing us the beginnings of a directional move, below 20 on the negative line, close to being above 30 on the positive. The ADX is rising. It's just so low. It's going to be a while before it gets above 20. So it's got the beginnings of a directional move, not quite a breakout yet. The bandwidth is pretty low too, but it's rising as we push up against the upper band. We're above the value area. Like I said, earnings coming out. And so, and remember again, if the market's a little bullish, I got to have some, or a little overbought, but you got to have something that can allow the room to run to the upside because of the trend, but allows us the ability to still profit if we go up and down or down and up, especially with the earnings. So of course that brings us to looking at selling a bull put spread, 325, 315, buying a bear call spread. By going $10 wide, selling the 400, buying the 410, right around those low 20s on the deltas. By going $10 wide, what this does is it allows me to get, typically, we're going for 30% return on risk on these short premium trades. $300 on $1,000 risk is kind of what we shoot for. But here I'm getting $300 plus on only $600 of risk. About 2/3 of my normal risk, which is great because of the earnings involved. So if we do have a big outsized move on earnings, I don't have nearly as much as risk. I don't want to lose 665. I'm position size in the worst case scenario to lose that, but I only want to lose 335 as much as I'm trying to make. So it'll be a lot easier for me to manage that kind of a loss with good position sizing like this than it would have been had I positioned bigger. Right, and the $10 wide strike allows me to do that in this particular case. So risk management is very, very important always, but especially when you have a risk event like an earnings coming up here. And now I have room for this to go up. It can go up all the way to $400, but I also have room that it can come down if we are a little frothy right now and still maintain the trend and still be okay. So, and if it goes down and up or up and then down, even that much the better. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. All of our subscribers, even our free subscribers, get access to that forum. So open up any threads there. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching our video today. I hope you had a great Thanksgiving. Remember to subscribe to our YouTube channel. Give us a thumbs up on the video as well as on Twitter and Facebook. Comment on the video. Have a great rest of your holiday weekend, everybody. Stay safe on your travels. Stay healthy. And we'll see you all on Monday.